Now that we understand the basic foundation of lease accounting, let's start to dive into the details. And as we work through ASC 842, we'll find there are essentially 5 steps we'll follow anytime we sign a contract that might include a lease. First, we need to identify whether we have a lease that falls within the scope of ASC 842. Most of the time, this will be pretty simple, but as we'll find in the next episode, the standard has a very precise definition of when we do or do not have a lease. And there are some specific scenarios where a contract may meet the definition of a lease but still fall outside the scope of ASC 842. Then second, once we've determined we have a lease under ASC 842, we need to identify and separate the lease and non-lease components of the contract. Many contracts will include multiple components and may have a mix of lease and non-lease components. Consider, for instance, an office lease where the contract covers both rent for an office and common area maintenance charges, or a lease for a piece of equipment that includes a maintenance or service component. As we'll learn, the maintenance and service portions of these contracts are non-lease components, and ASC 842 requires us to separate these, though it does provide a practical expedient to simplify this in many cases. And we'll look at this step in detail in a future episode. Then third, once we've determined we have a lease and separated out the portion of the contract that relates to the lease, we'll need to classify the lease. Remember, in this series, we're focused on the accounting from the perspective of the lessee. And for the lessee, a lease can fall into one of 2 categories. It will be either an operating lease or a finance lease. And again, the standard is clear as to how we go about this classification, and we'll do a deep dive into this as we go along. Now, once we've gone through these 3 steps, it's time to start doing some math and determining journal entries to accurately record the lease in our accounting records. So in the 4th step, we'll perform the initial measurement and record the opening asset and liability on our books. And you've now heard this term a few times. An asset within the scope of ASC 842 is referred to as a right of use asset, or ROU asset for short. And this makes sense. When we lease an asset, we're not purchasing the underlying asset itself. We're purchasing the right to use the asset for the term of the lease. And as part of this series, we'll look at all the detail of how we calculate this opening journal entry. And finally, the 5th step will be to record all the subsequent adjustments to our ROU asset and lease liability as we use the asset and make our lease payments. And while the opening balances we calculated in the previous step are the same for both operating and finance leases, the subsequent measurement and ongoing accounting will differ. Additionally, subsequent accounting can also include things like lease remeasurements and modifications, impairments, and terminations. And as we go, we'll walk through all of these, understand the calculations, and set up a workbook so you can track everything very easily. Now, throughout this entire process, each step is subject to judgments made by management. And this isn't an inherent weakness of the standard. It's written in a way that recognizes how varied lease contracts can be, and it needs to be able to cover the entire world of leases in the business community. But this does mean if we're responsible for accounting for leases at a company, it's important to have a deep understanding of ASC 842 so we can develop and apply detailed and logical accounting policies and procedures that comply with US GAAP. So in the next episode, let's start at step 1 in our process and look closely at how we determine if a contract contains a lease.